Welcome to the deep dive. Today, we are really getting into the details on Trident Ltd. You probably know the major Indian group, textiles, paper, chemicals.
That's right, and we're here to unpack their latest financial results. We've got quite a bit to work with, their investor presentation for Q4 and the full FY25, the press release.
The board meeting outcomes, and importantly, the auditor reports as well.
Exactly, all the key documents.
So, the goal here, we want to pull out the key numbers for you, understand what's driving the performance, really get a feel for the company's financial health.
And also see what management is saying about the path forward. Basically help you get quickly well-informed on Trident's latest pulse.
Okay, and just as a quick reminder, their main business areas are yarn, home textiles, that's bath and bed linen, then paper, chemicals, and also energy.
Right, so let's jump straight into the overall performance numbers, consolidated first.
Okay, Q4 FY25, the last 3 months. Consolidated revenue was INR 1883 crore. That's Indian rupees. Crore is 10 million. So yeah, over 18 billion rupees.
And that number was up quite nicely, 12% from the previous quarter Q3 and 11% compared to the same quarter last year. Healthy growth.
Yeah, decent top-line growth. How did that translate further down?
Well, the consolidated EBITDA, that's earnings before interest, taxes, depreciation, amortization, kind of a core profitability measure.
Right, operational profit.
Exactly. That came in at INR 264 crore, which is up 15% quarter-on-quarter and 18% year-on-year.
Okay, so profit grew even faster than revenue in Q4.
It did, and you see that in the margin. The EBITDA margin improved to just over 14%, 14.02% to be exact. That's up from about 13.6% in Q3 and 13.15% a year ago. So yeah, better efficiency in turning sales into profit that quarter.
And the bottom line, net profit.
That's where things really popped, as you said. Consolidated net profit PT hit INR 133 crore in Q4.
Wow, okay, how does that compare?
It's a big jump, up 67% from Q3, and get this, 126% higher than Q4 last year.
126% year-over-year jump in net profit for the quarter. That is quite a finish to their fiscal year.
It really sets the stage for the full year picture. So shifting to the full fiscal year, FY25 consolidated results.
Okay.
Total revenue for the year landed at INR 7047 crore. That's up 3% compared to FY24, so more modest growth for the full year.
Right, 3% top-line growth for the year, and EBITDA for the full year.
Full year EBITDA was INR 971 crore. Now that was actually down slightly, about 2.7% compared to the previous year.
Okay, so revenue up slightly, EBITDA down slightly for the full year. What about the final net profit?
Despite that small dip in the EBITDA figure, the net profit for the full FY25 was INR 371 crore, and that is up 6% higher than the 350 crore they reported in FY24.
Interesting. So a very strong Q4 really helped pull up the full year profit number, even with that slight pressure on EBITDA across the whole year.
Exactly. It paints a picture of, navigating what they call challenging conditions, but finishing really strong. That Q4 performance was key to showing positive growth on the top and bottom lines for the full year.
Okay, that makes sense. Now, you mentioned earlier they seemed keen to talk about the balance sheet.
Oh, absolutely. That was a major theme in their communications, strengthening the balance sheet, specifically debt reduction.
Right. What were the numbers there?
They cut their net debt by INR 635 crore during FY25. That's a significant chunk.
Wow. So where does that leave their total debt?
Net debt stood at INR 895 crore at the end of March 2025. That's down from 1530 crore just 12 months earlier.
Okay, nearly halved it. So for you listening, what does cutting debt like that actually mean? It flows through to their health metrics, right?
Precisely. The big one is the debt-to-equity ratio. It improved massively, dropping from 0.35 down to 0.19 year over year.
So much less debt relative to the shareholders' equity. Lower risk.
Lower risk, exactly. And another one, the current ratio, which measures their ability to cover short-term bills.
Yeah.
That also improved from 1.58 to 2.01, so a much stronger short-term liquidity position as well.
So overall, a much healthier, less leveraged company financially. That's definitely a positive signal.
Absolutely. And alongside strengthening the finances, they also announced something for shareholders.
Ah, yes, the dividend. What was the news?
The board declared a first interim dividend of 50 pays, so INR 0.50 per share for the next fiscal year, FY26.
Okay. Starting the new year with a shareholder payout. And they set a record date.
Yes. Tuesday, May 27th, 2025. They make a point of highlighting this as part of their, consistent dividend policy.
Right. Okay. Balance sheet stronger, dividend declared. Let's dig into the performance of the actual business segments now. How did yarn, textiles, paper, etc. do individually?
Okay. We can look at the full year consolidated revenue growth and then maybe the Q4 standalone EBIT margins for profitability. EBIT being earnings before interest and taxes.
That's good. Where'd they start? Yarn, wasn't it?
Yes, yarn. That's their original business. Consolidated revenue there grew 11% in FY25, reaching INR 3612 crore.
Okay, solid growth in yarn and profitability.
The standalone EBIT margin in Q4 was 9.43%. They often mention their backward integration here helps control costs.
Right, makes sense. Then home textiles, that's the towels and bed sheets. Big area for them.
Yeah, it is. Consolidated revenue for home textiles grew 2% in FY25, so slower growth there, totaling INR 300,968 crore.
Only 2% growth. And the margins.
Well, looking just at Q4 standalone EBIT margins, both towels and bed sheets came in at that same 9.43% mark, same as yarn for that quarter. They position themselves as a leading integrated player here, one of the biggest in India.
Okay, so similar profitability to yarn in Q4, but slower revenue growth for the full year in home textiles.
Yeah.
What about the third segment, paper and chemicals?
Right. Now, paper and chemicals, the consolidated revenue was INR 1,008 crore in FY25. That was actually down from 1146 crore the previous year.
A decrease in revenue there. But what about the profitability? You mentioned earlier it might be different.
Yeah, this is where it gets interesting. The standalone EBIT margin in Q4 for paper and chemicals was way higher, 22.28%.
Oh, 22%. Compared to just over 9% for the textile segments in Q4. That's a huge difference.
It really is. It stands out.
Do they give it any reason why? What's special about their paper and chemicals business?
Well, they highlight their specific niche. They're apparently the world's largest maker of paper using wheat straw, based in North India, and they focus on the branded copier paper market.
Ah, so maybe that specific process or market position gives them much better pricing power or cost advantage.
It seems likely. That unique raw material source, wheat straw, and the branded product focus probably allows for much stronger margins compared to, say, the more competitive, maybe more commoditized textile markets.
So even though the revenue dipped this year, that segment is punching well above its weight on profit contribution.
Definitely. It's a smaller part of the revenue pie, but a much bigger slice of the profit, relatively speaking. Something to watch strategically.
Yeah, absolutely. So speaking of strategy, what else did management say they're focusing on moving forward?
Well, the MD acknowledged the tough global backdrop, but obviously pointed to the growth they achieved. And as we discussed, really hammered home the strengthened balance sheet.
Right, the debt reduction. What about future plans?
They talked about pursuing strategic diversification. That means new product development and also potentially greenfield projects, building completely new facilities.
Okay, looking at expansion. Anything else?
Yeah, focus on innovative products, keeping up with consumer trends. They also mentioned potential tailwinds, things like recent U.S. tariff changes and the new India-UK free trade agreement could help exports.
And the core focus areas going forward.
They listed improving volumes, pushing more value-added products, which usually carry better margins, and continuing their focus on ESG.
Okay. And they have this big push, right, to make Trident a national brand.
Yes, that's a key strategic pillar. They talked about using e-commerce, setting up their own retail outlets, using social media more effectively, and generally diversifying the products offered under the Trident brand name.
So really trying to build that direct consumer connection and brand recognition in India.
Seems like it, and they're backing that up with tech investment too. Digital Trident initiatives.
Like what?
Things like Industry 4.0 in their factories, using AI, creating virtual showrooms for business customers, and also focusing on getting patents for their innovations.
Okay, so investing in brand and technology. Let's shift back slightly to operational health. Did they mention anything about how well they're managing things like inventory or getting paid?
They did provide some numbers on that. Inventory management improved. Their inventory days, which is basically how long stock sits around, came down to 64 days in FY25 from 75 days the year before. That's on a standalone basis.
Fewer days is better, means cash isn't tied up in stock for as long. What about collecting payments? Debtor days.
That improved too. Debtor days dropped to 16 in FY25 from 22 in FY24, also standalone. So they're collecting cash from customers faster as well.
Both good signs for working capital efficiency.
Exactly. And it ties into the free cash flow figure they highlighted in the press release. INR 690 crore generated in FY25 after accounting for capital spending. That's strong cash generation.
Okay. And you mentioned ESG earlier as a focus. Did they provide any specifics on their ESG performance or governance?
Yes, quite a few points, actually. They highlighted getting a silver medal from EcoVadis, that's a sustainability rating platform, with a score of 70 out of 100 in the 2025 assessment.
Okay, third-party validation. Anything else?
They reported their CDP scores C for climate, B for water. On the environmental front, they boosted their solar power capacity by adding 11 milliwatt, reaching almost 52 milliwatt total.
And that helps their renewable energy usage.
Right. They said they achieved over 52% renewable energy share in their total mix by March 2025 and avoided about 39,000 tons of CO2 equivalent emissions.
That's significant. Any other environmental points?
They mentioned their SBTI targets. Science-Based Targets Initiative were validated in Feb 2025. They're aiming for a 42% cut in their Scope 1 and 2 emissions by FY31, using FY22 as the base year.
So clear, validated climate targets
Ew.
and social or governance aspects.
They listed some CSR activities like health camps and cleanliness drives. On governance, they reiterated their consistent dividend policy, pointed out that 67% of their board directors are independent.
Which is generally seen as good practice.
Right. I mentioned their audit is done by S.R. Batley Co., which is part of EY, a Big Four firm. Plus, they listed their credit ratings AAA1+ from the major Indian agencies like CRISIL and CARE.
Okay, so projecting an image of strong governance and commitment to ESG. Now, just to put all this in context, did they mention anything about the broader market, the textile industry overall?
They did touch on that, referenced forecasts showing the global textile and apparel trade growing steadily, expected to hit 1.2 trillion US dollars by 2030.
And the Indian market specifically.
Ambitious targets there, aiming for a domestic market size of 250 billion US dollars by 2030-31. That requires pretty strong growth, around 9% as a year from now.
Okay, what about home textiles, their key area? How's that market looking in India versus globally?
The Indian home textile market is estimated around 10.5 billion USD in 2025, and it's expected to grow quite fast, maybe reaching almost 17 billion by 2030. That's nearly 10% CAGR.
Faster than the global market growth.
Yeah, the forecast for the global home textile market growth is lower, around 5.5% CAGR, although the market itself is obviously much larger overall. So India seems like a relatively high growth spot for home textiles.
Interesting context. And they're active in industry events.
Yes, they mention participating in Tex 2025 here in India, and Heimtextil, which is a major international trade fair in Germany, shows they're engaged both domestically and globally.
Okay. Now, before we wrap up, there was one specific item mentioned in the auditor reports that we should cover, an emphasis of matter.
Yes, that's right. It's important to mention this factually, as it's in the source material. The auditors included a specific paragraph in their reports.
And what did that paragraph state?
It stated that a search operation under Section 132 of the Income Tax Act, 1961, was conducted by the Income Tax Department.
Where was the search conducted?
At certain company locations, including manufacturing units and Indian subsidiaries, and also at the residences of some employees and key management personnel.
Okay. And just to be absolutely clear for everyone listening, we are reporting this because it's explicitly noted by the independent auditors in the official reports.
Exactly. This is just relaying a factual statement from the auditor's note within the source documents. It's not a comment on the outcome, any findings, or implications, just stating what the report includes.
Got it. Important distinction. So let's try and pull this all together then. What's the quick recap?
Okay, so Trident finished FY25 with a really strong Q4, which helped deliver modest full-year growth in revenue and net profit, despite some EBITDA pressure over the full year.
But the big story seems to be the balance sheet, right?
Absolutely. Huge focus on debt reduction. They cut net debt significantly by over 600 crore, leading to much healthier ratios like debt to equity and the current ratio.
They've also declared a dividend for the new fiscal year. And performance across the segments was a bit mixed.
Yeah, yarn grew well, home textiles grew slower, and paper and chemicals saw a revenue dip but had that standout much higher profit margin.
Right. So you've just heard a deep dive into Trident's latest numbers, their improved financial footing, and where they say they're becoming a national brand, digital investments, ESG. Hopefully that gives you a really solid understanding.
Definitely. And maybe a final thought for you to consider, building on all this. Trident has this clear strategy to make Trident a national brand, which likely requires significant investment. And they've just done this great job massively reducing their debt in FY25. So the question is, how will they balance potentially large future investments in brand building, maybe even new capacity, with maintaining that strong balance sheet and low debt level they just achieved? especially, given the ups and downs of the global and Indian markets.
That's a really interesting tension to think about, balancing growth ambitions with financial discipline. A great question to ponder. Thanks for joining us for this deep dive.